When we talk about valuing a business's future strategy, it's important to understand how discounted cash flow, or DCF, plays a key role. DCF helps us figure out what a business is worth today by looking at the cash it's expected to generate in the future, taking into account that money available now is more valuable than money in the future. This method is especially useful for investors, founders, or CFOs who want to make informed decisions about acquisitions, capital raising, or strategic planning. What makes DCF stand out is that it focuses on the business's intrinsic value, its fundamental ability to generate cash, rather than just market prices or asset values. It gives leaders clear insights into how growth initiatives, cost savings, or investments will impact value down the line. Plus, it builds confidence for investors by providing transparent, data-driven valuations. DCF also helps companies test different scenarios to see how various strategies might change their value, supports decisions on projects and acquisitions, and allows adjustments for risk by changing discount rates. So, beyond just numbers, DCF offers a practical and strategic way to look at the future and make smarter business choices. The first step in a discounted cash flow analysis is to forecast the free cash flows, which means estimating the future cash the business will generate over the next 5 to 10 years. Free cash flow is essentially the operating cash flow minus the capital expenditures, so it's important to carefully project revenue, costs, taxes, and any reinvestment the business will need. Next, you choose a discount rate that reflects how much money in the future is worth today and the risk involved with those future cash flows. Many analysts use the weighted average cost of capital, or WACC, which combines the cost of equity and debt. After forecasting those cash flows, you calculate the terminal value, which estimates what the business will be worth beyond that forecast period. This is often done using the Gordon growth model, which factors in a long-term growth rate and the discount rate. Finally, you discount all of the cash flows and the terminal value back to their present values, summing these to find the total current value of those future cash flows. This method provides a clear way to assess the business's value based on its expected financial performance. To find the enterprise value, we add up all the discounted cash flows along with the terminal value. Then, to arrive at the equity value, we subtract any debt the company has and add any cash on hand. For example, a SaaS startup projecting £2 million in free cash flow by year 5, growing at 30% annually, used a WACC of 12% and a terminal growth rate of 3%, leading to an enterprise value of £15 million. This valuation was crucial in securing Series B funding at a fair equity price. In another case, a mid-sized manufacturer evaluated a £5 million plant expansion with a 10% discount rate, resulting in a net present value of £1.2 million, confirming it as a value-enhancing investment. Meanwhile, a private equity firm looking at a struggling retail chain found that through operational improvements and cost restructuring, the future cash flows supported a £40 million valuation, which was £10 million above the market price, enabling a successful acquisition with a 20% internal rate of return. The DCF method offers an intrinsic valuation based on fundamentals rather than market trends, is customizable to specific strategies and risks, focuses on future performance, is transparent by showing how assumptions impact value, and is versatile enough for startups, mature companies, and project-based decisions. Discounted cash flow analysis relies on a number of assumptions, which means the results can vary greatly depending on the forecasts and discount rates you use. It's very sensitive to inputs, so even small changes in growth projections or the weighted average cost of capital can significantly affect the valuation. Because of its complexity, performing a DCF requires strong financial modeling skills and reliable data. It's also not the best choice for businesses with volatile or unstable cash flows, as this can make the analysis less reliable. Additionally, DCF doesn't take into account broader market dynamics, like how a company's competitive position or investor sentiment might impact its value. Despite these challenges, DCF remains one of the most respected and thorough methods for valuing a business. It helps organizations quantify what the future might be worth today, evaluate different strategic options, and make decisions based on solid financial reasoning. In a rapidly changing business environment defined by growth, innovation, and uncertainty, using DCF provides a disciplined approach to measuring future value and linking strategy to tangible financial outcomes. This makes it an essential tool for leaders, investors, and analysts who want to understand the real worth of a business's future.